Most of the global factors which affected markets in 2018 will carry into 2019. Thus, volatility will remain high in 2019. A key concern is slowing economic growth. In 2018, economic growth has peaked and is moderating, but it is not collapsing. This is happening against a backdrop of tighter financial conditions as the world emerges from a decade of easy money. In the US, the Fed has guided for 2 interest rate hikes. In our opinion, we think that although liquidity will reduce, it will not derail growth. Therefore, in our opinion, the US recession risk in 2019 is low, as we believe the Fed is able to employ policy flexibility to navigate the economy through this period of volatility. A key risk to emerging markets is the US-China trade war, which in reality encompasses much more than trade. In 2019, we expect this to continue to weigh on markets. Meanwhile, over in China, the government has introduced a slew of easing measures to counter the impact of the trade war and stabilize its economy. So, to summarize, we will have slower economic growth, tighter financial conditions, as well as the US-China trade war in 2019. So therefore, volatility will be the norm. So investors are encouraged to embrace it and navigate through it. So what does this mean for Malaysia? In addition to those factors, Malaysia has its own set of domestic challenges. Currently, we are in reset mode. In the words of our Finance Minister, Budget 2019 is pro-growth, pro-jobs and pro-poor. While the fiscal deficit target has been revised upwards, the GDP growth target has been revised downwards. Although GDP growth for 2019 is set to slow to 4.9%, we think it is still decent growth, and private consumption is expected to remain the key growth driver, especially with the sizable tax refunds. While foreign investors have reversed the net inflows from a year ago, the KLCI remains relatively resilient. The KLCI and the ringgit have outperformed their peers in the recent emerging market correction. Institutional reforms will create short-term pain as the government lays the foundation for longer-term growth premised on a cleaner government. If the government sticks to its agenda, then Malaysia is on the right track to becoming an interesting emerging market play again. Therefore, we remain constructive yet vigilant on Malaysian equities. Although there will be plenty to distract investors in 2019, we recommend staying invested. There will be pockets of opportunity and value, especially after the recent emerging market sell-off. So stay defensive, go for companies with strong track record and good fundamentals, and go for dividend yielders until better growth returns. So in short, while we do not deny that there are risks locally and globally, we would argue that the Malaysian market is able to absorb and disperse those risks.